Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked, the show that keeps more cash in your pocket without breaking the rules. I am David Robson, and today's solo episode is The Cash Flow Game, Essential Tax Strategies for Startups in Their First Year. If you are building something new and staring at a scary first tax season, this is your playbook. We will tackle cash flow, entity choices, bookkeeping, deductions, payroll, sales tax, credits, and smart year-end moves using quick case studies and plain English. My goal is simple: protect your cash and legally lower taxes so your business survives its first. Cash flow first. Open a separate savings account labeled tax and move a set percentage of profit into it monthly, treating it as untouchable. Many founders start at 20 to 30%, then adjust with quarterly checkups. Next, build a simple 13-week cash forecast. List each week's expected cash in, cash out, and ending balance. Include payroll, rent, software, loan payments, sales tax, and estimated taxes. Update every Friday, compare forecast to actual, and revise. Forecasting does not remove surprises, it shrinks them and buys decision time. Controlled cash beats clever deductions you discover too late in the spring. Your entity determines how profits are taxed and how you pay yourself. A sole proprietorship is simple and cheap, but all net profit is subject to income tax and generally self-employment tax. An LLC provides legal flexibility and can be taxed like a sole prop, partnership, S corporation, or C corporation. An S corporation can reduce self-employment taxes by splitting income between reasonable payroll and pass-through profit. A C corporation pays its own tax, with possible double taxation on dividends, but useful for venture funding, equity plans, and retained earnings when profits will be reinvested for growth. S corporation timing matters. It makes sense once the business shows steady profit above a market salary for your role. To elect S status, file Form 2553 within 2 months and 15 days after the start of the tax year, or after formation if mid-year. Missed it. Relief may be available if you intended S treatment and operated consistently. After electing, owners who work must take reasonable compensation through payroll. Document duties, time, skills, market data, and profits. Overpaying salary hurts cash, underpaying risks penalties, and reclassification. Review compensation annually as profits, responsibilities, and headcount evolve and your tax posture. Pick an accounting method and clean books from day one. Cash basis recognizes income when received and expenses when paid, great for early-stage services. Accrual matches revenue and expenses when earned and incurred, better with invoicing, inventory, or financing. Many small businesses can still use cash for tax with simplified inventory rules. Build a chart of accounts that mirrors how you manage, reconcile bank and credit cards monthly, and lock closed months. Use dependable software like QuickBooks or Xero, connect bank feeds, restrict user access, and backup. Good books create better decisions, clean returns, and faster funding too. Keep business and personal finances separate. Open dedicated checking and credit card accounts and run every business transaction through them. If you are not on payroll, take owner draws from profit, not random transfers. If you are on payroll, pay wages through payroll and use distributions for remaining profit. Adopt an accountable plan to reimburse employees and owners for business expenses paid personally. Submit receipts and business purpose, get reimbursed, and the company deducts the cost while you avoid taxable income. Sloppy mingling creates lost deductions, messy books, and heightened audit risk. Clean lanes protect you in your future returns. Track pre-opening costs carefully. Startup costs to investigate and create the business, and organizational costs to form the entity, can each receive an immediate deduction up to $5,000, reduced when totals exceed $50,000, with the remainder amortized over 15 years, starting when you are open for business. Keep a clear opening date. Adopt a written capitalization policy that expenses items under $2,500 per invoice or item, the de minimis safe harbor, and apply it consistently. This keeps small tools and equipment deductible now, improving cash flow without unnecessary depreciation schedules or headaches. Plan equipment purchases with depreciation in mind. Section 179 lets many businesses expense qualifying equipment up to an annual limit, but deductions are capped by taxable income and phased out by very large purchases. Bonus depreciation allows immediate expensing of a percentage of cost for eligible new or used assets, subject to scheduled phase downs. The golden rule is placed in service. You must have the asset ready and available for business use before year-end to deduct, not just ordered or paid. Document delivery, setup, and first use. Time purchases to match profits and cash and manage tax brackets. Everyday deductions matter. A home office is deductible when used regularly and exclusively for business. Measure the space and keep a simple floor plan with photos. For vehicles, choose standard mileage or actual costs and keep a contemporaneous mileage log. Allocate phone and internet between business and personal reasonably. Do not forget software, subscriptions, insurance, bank charges, and merchant fees. Travel is deductible when primarily for business, while meals are usually 50% deductible. Entertainment is not. Add who, where, when, and why to receipts. Payment proof plus business purpose notes is your audit shield. Store everything in the cloud. Classify people correctly. Contractors control how work is done, use their own tools, and can profit or lose. Employees are directed and integrated into operations. Misclassification can trigger back taxes, penalties, and interest. For each contractor, collect a completed W-9 before paying, verify TINs, and issue a 1099 NEC by January 31 for $600 or more. If you need control and ongoing availability, set up payroll early, handle withholdings and filings, and provide required state notices. Clean onboarding, signed agreements, and documented scopes reduce disputes. Good HR hygiene is good tax hygiene and protects your cash. Sales tax is different from income tax. If you sell taxable goods or services, you may need to register in your home state and in states where you have nexus. Nexus can arise from physical presence, employees, contractors, inventory stored in a warehouse, or economic thresholds based on sales or transactions. Marketplaces may collect for you, but you can still owe registrations and zero returns. Track customer locations, monitor thresholds monthly, and calendar filing frequencies. Late sales tax is brutal because it is trust tax with potential personal liability. Get registered early and price accordingly to cover compliance costs properly. Build estimated taxes into your cash plan. Federal quarterly payments generally fall in April, June, September, and January, with similar state schedules. Use safe harbors, paying 90% of current year tax or 100% of last year's, 110% for higher incomes. Coordinate with a spouse's withholding to backfill late year gaps. Add year-end moves. Prepay eligible 12-month expenses. Time equipment placed in service. Write off documented bad debts. And consider deferring or accelerating invoices based on cash and brackets. In January, reconcile accounts, tie payroll and sales tax, and assemble support for filing. Do not leave credits and benefits on the table. The research credit rewards design, coding, prototyping, and experimentation for new or improved products and processes. Eligible startups can apply it against employer Social Security payroll taxes, improving cash before profits. Pass-through owners may qualify for the qualified business income deduction up to 20% of qualified profit, subject to wage, property, and service limits. Add benefits. A solo 401k allows employee deferrals and employer contributions. A SEP is simpler but less flexible. HSAs pair with high deductible plans. For S corporations, run 2% shareholder health through payroll. Losses are not automatic tax gold. Deductibility depends on basis, at risk, and excess business loss limits. In pass-throughs, you need basis from cash you contributed, property you contributed, or loans you personally made to the business. Bank loans to the company do not create owner basis unless guaranteed and structured. Track capital contributions and documented owner loans with notes and repayments. If you hold inventory, remember purchases are not deductible until goods are sold. Finally, review state requirements, franchise or minimum taxes, and whether your state offers a pass-through entity tax election to bypass the SALT cap. Quick case studies. An LLC designer earned $120,000 in profit. We elected S status in year 2, paid a fair salary, and saved several thousands in self-employment taxes. A SaaS startup documented sprints in testing, then used the research credit to offset employer Social Security tax for multiple quarters. A cafe tracked pre-opening costs, captured the first-year startup deduction, and amortized the rest. When to call a pro. Employees, multi-state sales, inventory, losses, or investors are your signals. That is our show. You gained a cash-focused, first-year tax playbook. Go win today.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.